Welcome to the midlife financial sprint. You've already hit major milestones. You're debt-free, you've built a 6-month emergency fund in a high-yield savings account, and you've started contributing to Roth IRAs and broad market index funds. That foundation is stronger than most beginners. In this video, we'll turn that solid base into a focused plan to catch up quickly and build long-term wealth. First, we'll set expectations and a roadmap. Then, we'll move into a catch-up phase. Automation strategies, a sustainable budget framework, and the controversial but powerful lever of increasing income. Finally, we'll share resources, test your knowledge with short quizzes, and wrap with an actionable checklist. Here's our agenda. We'll begin by clarifying why your current position is powerful. Next, we'll cover short-term catch-up actions and how to automate them. We'll walk through a practical spending framework and compare Roth IRAs versus taxable brokerage accounts. After that, we'll dive into the highest impact move for under-earners, which is increasing income. We'll map everything on a 12-month timeline, share vetted resources, and reinforce learning with brief quizzes. With that in mind, let's transition to a quick but important disclaimer. Before we dive deeper, a quick disclaimer. This content is for educational purposes only and is not financial, tax, or legal advice. Your situation may be unique. Tax laws and contribution limits change regularly, and returns are never guaranteed. Please consult a qualified fiduciary advisor or tax professional to tailor these ideas to your circumstances. Now that expectations are clear, let's move on to why your starting point is a real advantage. You're starting from a position of strength. Being debt-free removes interest drag, and a 6-month emergency fund reduces the need to liquidate investments during downturns. Beginning with Roth IRA contributions gives you tax-advantaged growth and flexible access to contributions in emergencies. Broad market index funds provide diversified, low-cost exposure with minimal maintenance. With these pillars in place, you're primed for a focused sprint. Next, we'll outline the short-term catch-up moves to accelerate your progress. In the catch-up phase, the priority is to maximize tax-advantaged space, starting with your Roth IRA. If you have access to an employer plan, at minimum, capture the full match as part of your compensation. Next, put your progress on autopilot with monthly transfers. Each time you receive a raise, auto-escalate contributions by 1 to 2 percentage points. Favor broad, low-cost index funds to keep fees minimal and diversification high. Rebalance once per year, or if your allocation drifts significantly. After maximizing tax-advantaged accounts, direct overflow into a taxable brokerage invested in the same simple index funds for continuity. Keep your emergency fund intact to avoid selling investments in a downturn. With short-term moves in place, let's transition to a sustainable spending framework. This diagram illustrates the 50 to 60% allocation for needs, 20% for saving and investing, and 20% for guilt-free spending on what you truly value. The needs band is intentionally flexible to accommodate different living costs. The dedicated investing slice ensures you compound consistently, while the guilt-free category prevents burnout by allowing joyful spending, especially for your child or family priorities. Now, to clarify where to invest that 20%, let's compare Roth IRAs with taxable brokerage accounts. On the left, the Roth IRA offers tax-advantaged growth with qualified tax-free withdrawals in retirement. Contributions, though not earnings, can typically be withdrawn at any time without tax or penalty, subject to rules. However, Roth accounts have annual limits and may have income phase-outs. On the right, the taxable brokerage provides flexibility with no contribution caps but lacks tax sheltering. Dividends and realized gains are taxable each year. It's an excellent overflow vehicle after maximizing tax-advantaged accounts and can fund medium or long-term goals, including early retirement bridge years. With the hierarchy clear, let's cement consistency through automation. Automation sustains momentum. Choose a recurring monthly money day to process transfers to your Roth IRA, employer plan, taxable account, and any ongoing savings goals. Where possible, split your paycheck at the source so that a set percentage goes directly into investments on payday. Many people find multiple smaller transfers less psychologically jarring than a single large one, and it can partially smooth entry points. Commit to auto-escalating contributions by 1 to 2% with each raise. Reduce friction by hiding account balances from daily view, and set annual reminders to rebalance, review expense ratios, and confirm beneficiary designations. With automation humming, let's visualize the overall decision path. This flowchart starts by confirming you are debt-free and have a 6-month emergency fund. If not, you loop to build the fund and eliminate high-interest debt first. If yes, you proceed to maximize your Roth IRA. The next decision checks whether you have an employer plan with a match. If so, contribute enough to capture the full match. Overflow then goes to a taxable brokerage invested in simple index funds. The diagram includes annual loops for rebalancing, reviewing fees, and adjusting contributions upward with each raise. With the structure mapped, we can address the most powerful lever for accelerating results: increasing income. While budgeting matters, increasing income often has the greatest impact, especially for under-earners. Treat your skills as an asset and run focused 90-day sprints to acquire or level up one marketable capability, culminating in a portfolio project. Negotiate compensation proactively by researching market rates and practicing a clear, data-backed ask. Consider strategic career pivots into roles or industries with better earnings trajectories. Monetize side skills through freelancing or consulting. Emphasize tangible proof public portfolios, testimonials, and measurable outcomes. Finally, tie income growth to automatic contribution increases, so each raise compounds your investing rate. Now, let's place these ideas on a simple 12-month roadmap. The timeline lays out a pragmatic year. In months 1 and 2, confirm your emergency fund, set up automation, and verify you are using low-cost index funds. Months 3 and 4, focus on maximizing Roth IRA contributions, ensuring you capture any employer match, and beginning a focused skill sprint. In months 5 and 6, you build a portfolio project and rehearse negotiation. Months 7 and 8 are for executing the negotiation or applying across higher-paying roles. In months 9 and 10, you escalate contributions, rebalances, and review expenses and beneficiaries. Finally, months 11 and 12 channel overflow to taxable investments, reflect on progress, and plan the next year. With the roadmap set, let's test your understanding. Quiz time. Which action typically accelerates wealth fastest for an under-earner who is already investing consistently? Option A, maximizing Roth IRA contributions only. Option B, increasing income through skill building and negotiation. Option C, picking hot individual stocks. Option D, checking account balances daily. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is increasing income through skill building and negotiation. Raising your income increases the dollars you can invest each month, and when you automate higher contributions, your savings rate compounds over time. Now let's translate everything into a practical checklist you can follow. This table provides a priority checklist. Step 1 is ensuring a 6-month emergency fund in a high-yield savings account. Step 2 is maximizing Roth IRA contributions before adding to taxable accounts. Step 3 is capturing any employer match since it is part of your compensation. Step 4 is automating transfers to enforce consistency. Step 5 is using low-cost index funds to minimize fees. Step 6 is rebalancing and reviewing your risk profile annually. Step 7 is auto-escalating contributions with each raise. Step 8 is directing overflow savings into a taxable index fund. Next, we'll reinforce the mindset that keeps this plan sustainable. Sustainable wealth building is as much about psychology as math. Reduce or eliminate non-essentials that do not matter to you, and freely fund what brings real value. Aim for progress over perfection, since small, consistent wins compound. Automation shields you from emotional decision-making and distractions. Maintain your allocation through market noise and avoid chasing recent performance. Protect the downside through your emergency fund, diversification, and low costs. Finally, model healthy money behavior for your child to create positive generational habits. With the mindset aligned, let's point you to reliable resources. For deeper learning, consider books that emphasize automation, such as I Will Teach You to Be Rich. Explore communities like Bogleheads for evidence-based, low-cost investing principles. Favor broad market index funds, often in a 2 or 3 fund configuration, to keep things simple and diversified. Always verify current contribution limits and tax rules via the IRS website, as they change periodically. For ongoing education, follow podcasts and channels that focus on money psychology and index investing. Now let's do one more quick quiz to reinforce the budgeting framework. Here's a quick calculation check. If your monthly net income is $6,000 and you allocate 20% to saving and investing, how much is that per month? Option A, $1,200. Option B, $1,000. Option C, $800. Option D, $2,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $1,200. 20% of $6,000 is $1,200. Automation ensures this transfer happens reliably each month without relying on willpower. To close us out, let's summarize the key takeaways. To summarize, you have a strong foundation and are ready to sprint. Prioritize Roth IRA contributions, capture any employer match, and send overflow to a taxable index fund. Automate everything and escalate contributions with each raise. Use low-cost index funds and rebalance annually. Apply the 50 to 60, 20, 20 spending framework to align your money with your values. For under-earners, the biggest lever is increasing income through skill development, negotiation, and strategic career moves. Finally, review rules and limits annually and consult qualified professionals to personalize your plan. As a final note, let's close with a quick call to action. Thank you for watching. If this plan helped clarify your next steps, please like the video, share it with someone who needs a financial sprint, and subscribe for more actionable guides. Post your questions and your midlife money wins in the comments so we can celebrate and learn together.